we've seen the Fed hiking aggressively. We've seen the ECB able to finally, after almost a decade, bring rates to zero. And this is how dire the situation's in Europe. People were panicking because we're hiking interest rates to zero.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Inflation and slowing economic growth is affecting all corners of the globe these days, but perhaps nowhere as much as Europe, which is also dealing with a massive energy crisis. We spend a lot of time focusing on the U.S. economy on this program. One, because the majority of this channel's viewers reside in the U.S., and two, it's got the world's largest economy, and for better or worse, what happens in America drives much of the action that the rest of the world reacts to. But today, we're going to get a European perspective, both on the action in the US, as well as on the major challenges Europe is grappling with. I'm pleased to welcome Diego Parrilla, Managing Director of Quadriga Asset Management, back to the program. Diego, thanks so much for joining me today, all the way over from your offices in Spain.
It's my absolute pleasure, Alan. Thank you for having me.
Oh, thanks. Well, it's wonderful to see you again, Diego. A lot of questions for you, but let's just kick it off with the one I like to ask you whenever you're on the program. What is your current assessment of today's global economy and financial markets?
Well, I think if we take a big picture perspective, this is basically the time where the bluff in some ways is being called. I think, as I've mentioned before, monetary and fiscal policies without limits do not solve problems. They do a number of things. They delay those problems. You kick the can down the road through spending and debt. You can try to transfer those problems through currency wars and trade wars. You can effectively try to transform or those problems in the form of inflation and many of its consequences, such as inequality and others, such as civil unrest, etc. But ultimately, you are effectively enlarging the problem with arguably bubbles too big to fail. So I think this past few decades of monetary and fiscal policies without limits have been driven by a number of misconceptions. Such as you can print ad infinitum without inflation, you can do whatever you want, mommy and daddy are omnipotent and they're here to do anything they want and can. And to that extent, I think we are now in a situation where central banks are facing that delayed effect of some of those policies, which is coming quite aggressively. And this is coming arguably at one of the worst times with valuations extremely stretched and an economy that is slowing down and several other issues such as a war and a crisis on the energy sector. And I think all these issues are coming at once, and it's going to be, in my opinion, extremely difficult, if not impossible, for central banks to be able to pull this out. Something's going to give. And I think the situation is fragile. The actions that are being taken to fight inflation with hiking rates are going to obviously put a brake on a number of areas, but by doing so, it's going to expose many of the imbalances. So I think trying to find that optimal balance is going to be very difficult. And we're now in a situation where the market is quite complacent, and in a way reminds me of Q4 2018, right? The time when the Fed was normalizing things after a long decade of monetary and fiscal abuse, and it looked like everything was okay until things started to crack, and effectively we saw how the Fed was forced to revert and take us from 2.5% to 1.5%, and this was prior to COVID. What's happened since has obviously made the situation way worse, and the current hikes have taken us already to those levels. So I think as we head into the August and September Fed meetings with the hikes that are expected, I think we're already into pretty dangerous territory for I think the level of debt that we have. So it's a very an extraordinary time from a macro perspective. I think we are in the midst of a paradigm shift. The next decade, I think, is going to be quite different to the previous one. And in that sense, this has major implications for macro, for the markets, but also for portfolio construction, for volatility, and many other things.
Okay, that was a great answer, and we're done because you just addressed everything that I was thinking about. No, you gave me lots of great jumping off points here. So it sounds like, Diego, if I can just sort of encapsulate all that, it sounds like you think that the system is very fragile and is probably going to become more so. And so it seems like you're very skeptical that the central banks are going to be able to engineer a soft landing here. At the same time, it looks like the markets are, I'm going to put words in your mouth, you can correct them, but are far too overconfident for the degree of risk involved here. And so what I sort of take away from what you're saying is we're sort of in this temporary period where one of those two things is going to be proven wrong, right? You know, either the Fed's going to have a wonderful, the Fed and the other central banks are going to have a wonderfully soft landing and everything's going to be just fine, or if your skepticism is proved out, the markets are going to have to realize that they are continuing to overprice things here. Is that a good, somewhat overly simplified?
Absolutely. And I think, as you said in the introduction, obviously the U.S. and the Fed are driving, things. Is a key economy. It's a key range of monetary policy. But we have seen China yesterday, as of recording, how they were cutting rates. So this is evidence of the sort of divergence that we might be seeing, and how arguably we know what we need to do, right? I mean, central banks and governments know what they need to do. China is particularly good at that, right? They know exactly what they need to do. But as Mike Tyson would say, every central bank has a plan until inflation punches you in the face, or growth punches you in the face. So I think the reality is different, and we're already starting to see some of that divergence, which evidence of underlying systemic, structural, and a number of other issues. But yeah, I think it's fragile, and this extremely aggressive price action from the Fed. I mean, bear in mind that we're seeing 25 basis points would be the normal pace. We're doing things at 50, 75, and even talks of 1%. This is obviously showing that they're massively behind the curve. They're massively miscalculated a lot of things, and they're trying to catch up on things that are very difficult to undo. Think about, I often compare, monetary policy or inflation to radiation. Whether it's solar radiation, after you've spent the entire day on the beach without any protection, sun cream, and by the time you get home you're completely burnt. It's too late. I mean, or worse, I think this is much more like nuclear radiation, right? You might be in a place where, hey, it's okay, nothing's happening, and within a few hours or days you start to see the effect. So
your face melts off.
You glow at night and things happen, right? So I think this overconfidence, as you said, from central banks is got us into a situation where I don't think we should have ever let things go as far. And that overconfidence, which is in my view negligent or worse, it's going to put us in a situation that would be very difficult to handle.
I want to go all through all the questions I have here, but one question I just would love to get your quick feedback on is, you say you think it was negligent overconfidence that has sort of led us to where we are today on behalf of the central planners. And I've certainly had other guests on where we've railed a lot about exactly that. I'm curious, how much of it do you think may also just be sort of basic human nature, conscious or subconscious, where each leader is just playing for time to make sure that the system doesn't blow up on their watch, and so they do whatever they need to do just to keep the thing patched together until they can hand it to the next, hand it all to the next person who's going to run it, and so it's been this sort of game of like, past the hot potato or past the radioactive fuel rod or whatever. And at every point, it's getting worse and worse. And it requires more magical thinking or more extreme measures just to kind of keep everything tight. But of course, those extreme measures just make the eventual, implosion of the system. It's going to be even more damaging. But I guess this is sort of what people call kicking the can, right? Where it's the guys that have been running the show. Maybe it hasn't been part of a nefarious plan. Maybe it's just more been sort of like I don't have a very good system here. I don't have a lot of great options, so I've got to take this extreme measure. The next guy who gets that says, oh my gosh, my options are even worse. I have to take even more extreme measures. And you just get to a point at which it can't be punted off anymore. And at some point, the reckoning's going to happen.
No, look, I think you bring two very important points that I'd like to elaborate on. The first one is this short-term versus long-term dilemma, right? Yeah. And this is, as you said, is very much human nature. It's not just politicians, right? We want to be super fit, but we also want to have the chocolate cake, right? Or we want to, is the short-term versus long-term, is the everything in life, studying versus having fun or whatever. And I think the issue here is, and the temptation and the problem is that many of the measures that are taken on a short-term basis are sold to us as temporary, right? As kind of extreme, everything, and it kind of feels a little bit that, if you follow boxing, every other month there's the fight of the century, right? Which is kind of ridiculous. Because you have that sort of hype that the last crisis is just this big emergency that requires us going all in with debt and spending, and effectively what you see is that these temporary measures, these extreme emergency measures, become normalized and they become permanent. And think about pretty much anything that's happened, right? From all the way to taxes through obviously monetary policy, and how. Whatever, negative interest rates, or even, MMT, but there's lots of things. QE is a good example, right? QE started out as this emergency measure, and it was completely, it has become very much core. So I think the short-term, long-term dilemma it's a problem, but as you said, as we kick the can down the road and those emergency measures become, more permanent, then it becomes you also subject to the law of diminishing returns. So, it's no longer enough to print 600 billion. You start doing things like QE infinity. I mean, look at Europe, right? With the new TPI, right? You have a situation where how much you need to save Italy and Spain, and how much you need to prevent these yields from going. You're sort of getting into a situation where this thing becomes, it perpetuates on itself. So this is the first dimension. The second issue associated with this is the fact that central banks, governments don't operate in a bubble, in isolation. They're effectively subject to other people's behaviors. And that's why I think currency wars and trade wars are so important and are a key part of monetary and fiscal. If I was to look, rewind a little bit and look at the situation in Europe, how did we get into a situation where we have negative nominal interest rates? I mean, such an aberration, so something so crazy. And to be honest, it starts from an ECB that was extremely orthodox, right? In the 2008 crisis, and as Bernstein's was going down, Europe was hiking rates, and we're very focused on inflation and very paranoid about printing money because of our history, particularly in Germany. But then what happens is, the Fed and basically the UK and several other countries went very aggressively with QE, and effectively what happens is the euro appreciates significantly, right? So you lose a lot of competitiveness, arguably when you need it the most. And this is, if you think about what happened between the euro and the dollar, which went all the way to 150, you have a situation where it's not just Europe losing competitiveness versus the US. It was also losing competitiveness versus China, which was pegged against the dollar. So what happened in 2012, in my view, is the European crisis we suffered was in some ways related to this issue where other people were exporting their problems. They're transferring those problems through currency wars, right? They are effectively benefiting from these things. And what it does is someone like Mario Draghi walks in and says, guys, I'll do whatever it takes, obviously to save the euro, but I also want to compete and defend myself. And so negative interest rates are only explained on a relative basis. Yeah, to put it differently, we would have never ever had negative interest rates had the Fed been at 2%. We went negative because the Fed was at 0. So it's a relative game. You want to devalue your currency. You're trying to effectively not just defend yourself, but also counterattack. And this is it's almost like the nuclear escalation, right? As everybody was building nuclear heads, then other people had to build them, and it got to this point of mutually assured destruction. And I think there's some parallels with monetary policy, where as everyone keeps, trying to print their way out, and you might sell it as a domestic issue, but in practice it has also foreign implications, and people defend themselves. This gets us all into these dynamics, which ultimately lead to trade wars. It leads to, okay, you want to devalue by 20%, I'll tariff you by 20%, okay? And these things are all, again, we're not solving problems, they are effectively eventually enlarging them. So I think the combination of the short-term, long-term human nature and what it means in terms of, again, making not under my reign, sort of kick the can, and all these temporary measures that become more permanent, have also implications on a broader base with other players in the game, and this makes things ever so more complicated.
Well, absolutely. So it's a completely hyper-connected world, as you just did a good job of explaining here. Just to tug on that thread a little bit, as many things sometimes happen, is you make a short-term decision to address a short-term issue, but it sets you on a longer-term course. So you talked about the dollar weakening at the time that the ECB was hiking, and then the euro strengthened versus the dollar, and that led to competitive issues. And then Draghi came in and said, look, we'll do whatever it takes. So I'm oversimplifying a very complicated system here, but it sounds like you're making the case here that a lot of what Draghi intended to do was to bring the value of the euro down versus the dollar. And this is, I think, sort of what people talk about when they talk about the race to the bottom with currencies, where, currencies, if you're trying to devalue your currency against somebody else, and then they see that and they're trying to devalue against you, everyone's competing to sort of have a cheap currency to help their exports. But I think in a rational world, if you ask somebody, hey, do you want to, basically have your policy be to drive the value of your currency down towards worthless, people would say no, but you end up in that world kind of anyways. So now we're in a world where the dollar has been strong for the past year, quite strong. It's back at parity with the euro at this point. How does Europe feel about that? Are they happy about that, or it's not just as simple as lower currency is better? I'm sure that creates all sorts of other issues too.
No, absolutely, and this is why this game is so much fun. I mean, it's like playing golf. Even if you play the same course every day, there's always going to be a different game, right? The wind or where the ball goes, it's fun. Certainly, the point you're making is very important, and I think that this time around, currency wars are playing in a slightly different way. Why? Because a weaker currency, is not free lunch. Okay, you obviously have. You're more competitive, so China or whoever might say, look, I'm going to devalue my currency, please send me your money, your technology, your labor, your investment, right? And I'm going to do this, I need it. You do it at the expense of inflation, okay? And potentially creating bubbles, because, think about the price of oil in dollars and the price of oil in a currency that is much weaker, right? So effectively, this is a trade-off, and why trade wars are sort of checkmate on currency wars, and why it becomes so tricky. But I think this time around, you have a situation where, as you pointed out, things are a bit different. And I believe there's more room for the dollar to appreciate because in a way, the US is facing a big problem alongside everybody else, which is inflation. But by keeping a stronger dollar, they're actually passing that problem to somebody else. Or put it differently, the guys with the weaker currencies are suffering this in a bigger way. And this is part of the reason why I think the dollar has legs. I mean, we talked earlier briefly about monetary divergence. And, you know, we've seen the Fed hiking aggressively. We've seen the ECB able to finally, after, you know, almost a decade, bring rates, you know, to zero. And this is how dire the situation's in Europe. You know, people were panicking because we're hiking interest rates to zero. It sounds like a bad joke, but it is. Terrible, right? It's phenomenal. It's phenomenal, right? You have to go and intervene sovereign spreads because you're hiking rates to zero. That's how crazy the whole thing is. But then you have other people like China that are basically going the other way and cutting rates. But I think this ties in with many other things. And we talked about why the stronger dollar and perhaps linking it to the energy situation. This is obviously Europe is and Asia to a certain extent are suffering the energy crisis much more than the US. This is not really about crude oil prices, which is more of a global commodity. This is really about things like natural gas, which are much more regional. Okay, it's very difficult to take a gas, you know, natural gas in the US and send it over to Europe if you don't have the pipes, which they don't exist, or if you don't have the liquefaction capacity, which is a massive engineering feat and major investments. So
right,
in that sense,
but the liquefying capacity and then the the regasification on the other side.
Absolutely, but this is 99.9% of the difficulties on the liquefaction. I mean, you can take natural gas and take it from current temperature to minus 200 and something, and that's the difficult part. Good luck doing it, okay? Now, once it's there, you can transport it, and then once it gets to delivery point, all you need to do is just let it expand and go into normal temperature. So the real issue here, the bottleneck, is not so much regas, is liquefaction, right? And that liquefaction are 5 to 10 billion clips that take, you know, 3, 5, 7, whatever years, and they just don't happen overnight. So
I'm sorry to interrupt, and I might be wrong here, and if I am, we can totally edit this out. But my understanding is that you need to have a specialized port to receive the liquefied natural gas, and there are only so many.
Special what?
Like a special port?
Well, yeah, but of course there are in the order of magnitude of the difficulty. I think it's largely it's much more. It's much easier to resolve. So of course, you know, you can just go anywhere and land anywhere. That you need certain measures, but I think the key point that we need to make people understand is that there's the natural gas crisis is creating a major divergence in energy prices and energy volumes. Okay, I'm going to elaborate on those 2 points, whereby basically, if you think about natural gas in the US, people might be following the prices of Henry Hub. And part of the problem in commodity markets is that we use very funny units, right? So every commodity has this dollars per barrel, you know, whatever, pence per megawatt, tons, euros, whatever, tons. So when you put things apples with apples, in the case of nat gas, you need to multiply by about 5.8 to make it in barrels of oil equivalent. So approximately, you know, call it $8 an MMBTU, it's roughly, you know, $48 a barrel equivalent. So we're talking about nat gas prices in the US that are high in absolute terms, but they're still half or so of crude oil. In Europe, we are, you know, almost 10 times higher than in the US. So what it means to have such high prices for natural gas means effectively high electricity, means it's very difficult to compete. But the point here with the prices and volumes is very important because we're having shortages in volumes and high prices. You could if there's nothing you can do when you don't have the volumes. Okay, you can't print natural gas. So if that natural gas is not flowing, your factory is not working, and you're going to have to close, shut down, lay off people, whatever. Which is what's been happening in slow motion for a while. You could potentially address prices through subsidies. And I love this case because it's sort of back to the first question you asked, is the typical central bank and government reaction is, I cannot print natural gas, or I cannot print energy, but I can print euros to subsidize energy prices. And it might look as if you're solving the problem because us consumers are protected, right? You say, well, I'm now only paying X for electricity or whatever. There's a couple of problems with this. The first one is that when you introduce these subsidies, yes, the consumer is capped at how much they pay, but it effectively destroys the price elasticity of demand. So effectively, to put a blunt example, in Saudi Arabia, electricity prices used to be free. So people would turn on the aircon and leave the windows open, and it didn't matter because it was free, right? It's like, who cares? Now, when you're paying the bill, it's a different story, right? So in that sense, if your prices are zero or capped, you don't fully appreciate what the real value of that is. So effectively, you don't get to have the demand destruction that you would otherwise have or need. And what it means is that prices are going to go way higher than they would have done otherwise.
Yeah.
And the other thing is that where's this money coming from? How are governments effectively paying for these subsidies? And the answer is always the same. It's printing and borrowing, right? So in some ways, the euro weakness, back to the point earlier, in my view, also comes from the fact that we have a big problem on the energy side. It's not just other structural issues, but the energy side of the story, the war between Russia and Ukraine, it's impacting us in a much bigger way than other parts of the world, and particularly the US, which has a major competitive advantage on the energy side. Asia is also in trouble on the energy side, and these are things that effectively eventually show up through the currency. The currency is always the degree of freedom of the system. You can ask Chavez in Venezuela or whoever, they pretend they can do whatever they want, they can expropriate, they can force things and do this and that and spend or whatever. Ultimately, the currency is the judge. And I think we're seeing all these things kind of aligning for stronger dollar, where under normal circumstances you would have seen a much more defensive, Fed, because they obviously would worry about a very strong dollar. In this particular case, I think things have changed, and a strong dollar actually is somewhat welcomed in the sense that they're exporting their biggest problem, which is inflation, and that is effectively hitting the other guys in a double or triple way. So it's very closely, as we discussed earlier, all these dynamics are very closely interlinked, but ultimately the basic model we discussed earlier works very well. If in trouble, print and borrow and subsidize and nationalize and do whatever, and this will eventually always show up through the currency and other imbalances such as inflation and bubbles, which effectively lead the country in a way worse position than they started. So this is why I'm so critical of these abusive, negligent policies without limits.
All right, and it sounds like, you said U.S. is kind of happy to have the strong dollar at the moment because it pushes their problems on others. Very true, and probably hitting nobody as acutely as it's hitting Europe right now. And you just talked about, the policy response, which will be everybody eventually going back to printing, subsidizing, all that stuff, will just make matters worse in the long run. I assume that's just accelerating most quickly in Europe at this time, given what's going on there. Diego, I know you're not an energy analyst. You're more of a macro, investor, but you watch these markets closely. You live in Europe. Just real quick, what is the situation like there, energy-wise? Is it getting better? Are they finding ways to address these major challenges? Maybe not completely efficiently and effectively, but they're beginning to kind of get a plan in place, or is it getting even worse? And one of the big differences, you mentioned that Asia is feeling a similar pinch, but Asia doesn't have to worry so much about its population freezing in the winter the way that Europe does. So energy is so important because without energy, you can't. That's what drives the economy. Less energy means less economy. So every nation worries about that from an economic standpoint, but there is a bigger sort of existential concern around energy in Europe, which is that, hey, it gets really cold in parts of it in winter and people could actually die if they didn't have enough heat. So anyways, is it getting worse or is it slowly getting better at this point?
We're obviously in the summer. As you point out, it's very different to use your energy for aircon than heating. I mean, aircon, sorry guys, you have to live without, and that's it. But the winter is much more dire, and I think people are counting the chips, and we see that it's going to be if things continue the way they're going now, it's going to be an extremely difficult winter. And places like Germany are really trying by all means to get other parts of Europe to contribute with gas. Inventory levels are already very low, and heading into the winter, the risks are very skewed. This is obviously something that gives Russia a very strong hand, and unfortunately there's no easy or quick way out. So I think energy will continue to be a key driver of global markets. It's one of the reasons why Europe, I think it's in such a fragile situation. And countries like Germany, which are very industrial, are again being hit not only by the prices but the volumes. And so we are in Europe trying to address this in the best possible way, liaising with North Africa and whatever we can to get hold of this energy. But Asia may have a less of an issue in some parts, but they have a big issue themselves as well. And I think this brings the point of energy security, right, and energy independence and stuff. And I think once we get into hoarding and the issue becomes, social unrest and revolts, price goes to a second place, right? So, and you're already starting to see that across a number of commodities. The last few weeks have been interesting because the market is kind of swinging from two extreme scenarios, right? From the stagflation, print, inflation, and all real assets go up, to this scenario of recession and slower demand. I think we are much more on a stagflationary path, and Europe in particular, I think, is in that trap, unfortunately. So sincerely hope the situation with Russia will be resolved, but as time goes by, the clock's ticking and the factories are suffering, and the inventories are going down, and it's going to take a while. Even if things were to normalize, you're still in low inventory levels, so you need to build those inventories just to get those cushions, and that means there's limited room for negative surprises. So this is the unfortunate situation, and again, Russia is playing their cards very aggressively, and I think it will have implications longer term. But over the next few months and possibly years, there's not so much Europe can do without significant cuts and pain.
All right. I'm very sorry to hear that, but I totally understand the logic. All right, just a couple questions around the specific situation with Russia. Living in Europe, being a European resident and reading European media and whatnot, what is the degree of hope that things could resolve in Ukraine and trade relations with Russia could be restored in any kind of nearish term time frame that could help the energy crisis there? Is it nil? Is it optimistic?
It's not optimistic. I think there are obviously plenty of scenarios, including something was to happen to Putin himself. But I think a scenario where Putin is still around is going to be quite difficult to manage politically and for the markets. There's no easy or obvious end to the conflict. In fact, the risk is potentially the other way around. It's some unintended consequences that create some escalation, some miscalculations, some whatever. But yeah, there's no discussion here whatsoever, at least from my perspective, with sort of peace talks or things that are looking to find a compromise. The first efforts between Europeans are being, let's try to do as much as we can without asking Russia for favors, and that's creating a lot of tensions, between the different partners, with Germany and Italy and Spain and France and whatever. So yeah, I think the best case scenario is Putin, one way or another, disappears. The issues get blamed under him, and Russia can basically come back with a clean slate to basically normalize things. But that's obviously a possibility, but which could happen any minute. But outside of that, I think it's a tricky one.
All right. So yeah, it sounds like hope for a coup is kind of the strategy, but as everyone hears, hope isn't a great strategy in and of itself. All right. So to your point about Europe, trying to play within its member countries there of hey, what, how can we be as resilient as possible by, helping each other? You hear stories about how one of the reasons why Germany is in such a bind here is because it perhaps moved too quickly towards a more renewable based energy grid, and as a result, it's now got these shortfalls because it's lost a lot of the other fossil inputs that it was depending upon to fully make it through the transition, and it has been decommissioning nuclear plants, and some people are saying, well, that seems kind of crazy. Maybe they should at least put a pause on that if they are not going to be able to get all the Russian fuel that they had expected to be able to get here. I guess where I'm going with this is the resistance to decisions like that beginning to change as people are saying, look, we, by hook or by crook, we got to kind of cobble together our own, energy security here?
Absolutely. I think the case for nuclear is very obvious, and you can change the narrative from being a terrible thing to being green very, very easy, very fast. And that, I think, it's very much at the center. I think everybody, even prior to this Russia debacle, everybody knew that Merkel's decisions might have been a little bit rushed. I think the decision to shut things down was within a week of Fukushima, and it doesn't make sense on so many fronts, right? It just made the country very vulnerable, very somewhat naive to put ourselves in this position, and the talks are certainly there. So we're going to look for any possible way to do that, and how different countries react. And we'll see, but that also applies to places like Iran or even Venezuela, right? You go from being these evil guys to suddenly, hey, look, let's just be friends and try to find a solution. So as it's a bit cynical, right? But it's what it is. Ultimately, if we need the energy and we need those volumes, there are issues that will move to secondary front, and the U.S. is taking a very aggressive measure with the SPR, basically this large strategic inventories being used to take some pressure off inflation, etc. But those things will have to be rebuilt over time, etc. So this, things like Iran or Venezuela, again, can make sense, and it all goes around, I think, how the politicians decide to change the narrative to fit their purpose. So the reality is we're all united in the sense that we need that energy, and we want to get it in the cleanest, most reliable, cheapest possible way. And I think nuclear has a very strong case to come back with force.
All right. I now want to get into, at the end of this conversation, where you see the most interesting potential, as an investor going on here. So if nuclear energy or other forms of energy are part of that, let's definitely earmark that for later on in the conversation there. Real quick, just to close out the Russia topic here. When the war started, there were some people who thought, Putin's a madman. Why is he taking this risk? He'll never be able to, subsist as a pariah from the rest of the world. And others were making the case of, hey, he feels like he's got a winning hand here, that he holds, these critical energy resources that are, absolutely critical to Europe. And obviously other parts of the world will buy them if the West decides not to buy them. As it's playing out right here, and not asking you to comment on the morality of what he has done, but do you see him as holding a lot of good cards here and playing this game well, or do you feel like it's at the end of the day, sort of a foolish endeavor?
No, look, I think energy security is a double-edged sword. So from consumer countries, we think about energy security as securing supply. But producers have also energy security issues. They need to find those markets. And I think, Putin miscalculated his hand. He perhaps was expecting something more a la Crimea, where, maybe not so much resistance, but I think the risks were calculated. And for sure, he's been thinking much more east than west. I think, as I said earlier, with Putin in charge, there's no way Europe will rely heavily on them. We'll try to cut it off. But, something I posted at the very beginning, when the war was started and there were like votes at United Nations, etc. It was very interesting to see. Obviously, Russia vetoed the decision, but it was interesting to see the people who abstained, right? And there were three abstentions, and one of them was the UAE, the United Arab Emirates, so not so huge, but the other two were China and India.
Yeah.
So if you do the vote on a population weighted, those two guys account for multiples of all the other guys combined. So clearly, I think the energy security or generally that exit for the commodities is part perhaps of a trend that we're seeing more generally, which is, we went for a world based on globalization, where inventories were optimized to the point of just minimize them, and everything was so over optimized, to a world that is much more fragmented and polarized. We saw the fragility of the supply chains with COVID. We've seen wars emerging. We've seen a lot of things that are effectively leading to a fragmentation of that model and a much more self-sufficiency, whatever. So I think in the overall scheme of things, seems to me like the world is polarizing once again, with China, Russia on one side, and I think the key thing for Putin is whether China is on their side, and the fact that we are seeing noise around Taiwan and other areas that arguably are small economic prices, you could argue in the overall scheme of things, they are extraordinarily important for China, and I think everything that is happening is polarizing things further. So to me, this is a bit of a confirmation. Yes, there was some degree of miscalculation, but I think the plan was clear, and they have a strong hand. It's a strong hand in the short term. The measures that have been taken are obviously hurting Russia enormously, and so I think the cracks are everywhere, are both in Europe and Russia, and there's no winners from this. But we're already, many months, many dead people, a lot of damage, and again, I think this has a lot of implications with other key players or actors, such as how the U.S. is responding with Ukraine, and how China and Russia and India or whoever might be playing out, because this is, I think, overall is more of a symptom of a bigger issue that we're facing on a global scale. Is this period of Goldilocks of everything's good, you can actually take a plane for the weekend and go and visit Prague, and everybody can afford all these things, and everything's cheap, everything's available. I think we are coming to a bit of a reckoning, and this brings a lot of considerations, as prices go up, what it means for inequality, for social unrest, and other things. So in that sense, I think we need to be mindful that these are big issues that can go in either direction. They can hopefully get better, but there is room for miscalculation, and in the meantime, again, we're in a situation that is delicate. So not a very happy message, but I think we need to be pragmatic and realistic about where we are.
Okay, and so at the very beginning of this interview, you used the term paradigm shift, and that seems to be exactly what you're saying here, which is, economically, we're going to see lots of changes. Geopolitically, the changes that are underway, you think, are going to only continue as the world may become more polarized. Seems like you have a lot of sort of social stability issues. So let's actually sort of dig into that right now, which is the global economy is slowing, inflation is raging in many places across the world. We have trade complications going on. We have supply chain issues still. So there's a lot of bad things sort of swirling out there. The question I want to ask you is just sort of like, well, how bad do you think things are going to get? I realize that's a really big, amorphous question. So why don't we try to focus it on sort of the next year? You recently wrote that you expect a, quote, volatile and hostile second half to the year as multiple risk factors collide. What are you watching most closely here? What do you think is going to be most important, and sort of, how is this all going to manifest going forward? Are we going to see market corrections? Are we going to see economies tip into recession? Are we going to see more Sri Lankas as people rise up against governments that aren't able to, manage the impact that their populaces are feeling here?
Yeah, I think they're all.
Our interview with Diego will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our new practice of publishing my top takeaways from these weekly interviews. To get mine from this interview with Diego for free, just go to wealthion.com/AdamsNotes. And finally, if the challenging macro outlook Diego's detailed in this interview has you feeling a little uncomfortable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks Diego's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Diego Parrilla.